What is up, everybody? My name is Sean Grapevine. I am the co-branch manager of the Atlanta branch of UMortgage, and you have joined us here for the Monday market update with myself and, as always, the man who put the O in CDO. When the yield curve is inverted, he's completely upright. He fills his rate stack with the same thing he fills his Acura with, extra premium. He's the first ever Goldman Sachs associate to be rated AAA plus by Standard & Poor's and Moody. He's the Baron of Bips, the Titan of the 10-year, the awesome, the amazing Austin Koenig.
Thanks, Sean. I appreciate the intro. Thanks again, and keeps on getting better, like I always say. But truly, is the fact of the matter is we are seeing an inverted yield curve, and let's talk a little bit about what the Fed had to say this past week.
Yeah, let's get into it. That was a kind of a snoozer until Jerome Powell took the mic and dropped it.
Yeah, and that's kind of what we talked about last week too. Was we think 75 bips, but we want to see what Jerome Powell has to say after the fact, right? And I think there's a couple things to take away. And at the end of the day, there's a couple views that you could see as hawkish or dovish, but I'd say overall hawkish is the tone of this statement. And to kind of really put it in layman's term, hawkish means tight Fed policy or rate hikes, no easy money. Dovish means more progress to going towards easy money, all that good stuff. So let's kind of think about that when we hear hawkish or dovish. And generally what the Fed said and what Jerome Powell said was, look, we see the market, shouldn't be pricing any sort of pause in our policy for, non-tight conditions, essentially. So don't think we're going to pivot just quite yet. Do we think we're going to keep on doing jumbo rate hikes? They weren't so clear on that. I think what we might see in December could be another 50-ish BIP hike. I would say that's kind of what we're expecting. Just so everyone's on the same page, we have a Fed funds rate of 4% right now. A lot of the market, I would say, is now positioning closer to a little bit above 5 as the terminal Fed funds rate. So think of that as 100 to 125 basis points left to go in terms of hikes. So we have one more meeting this year. We'll see what happens there, and the data that we've gotten since the meeting obviously was another jobs number that doesn't look like the labor market's cooled off at all. We still have, obviously another month of data that we'll have with inflation and all that good stuff, but that's, the inflation numbers coming on Thursday.
Sure.
But for the most part, this is, still a hawkish statement by the Fed, and I think the market has adjusted their pricing for that. And, we're still seeing a 10-year at around 4.15 this morning.
So tell me this: how quick? All right, the Fed was obviously maybe a little slow to react to inflation, but then quick to put on the gas, like I'm sure you do on your way to work every morning in your Acura. I don't know why I'm.
I walk to work.
Okay, all right. Do you walk as fast as Anthony Casa?
No, that's what I call jogging. So,
it's not for the faint of heart. So, okay, so they were slow to act, but then quick to press the accelerator. If the PCI comes out, lower than it's been, so that the PCI, what does it even stand?
The CPI.
CPI. Oh, but we also go with the PCE.
Correct. Yeah.
Right. Okay, two different inflation measures. CPI. Sorry. So CPI comes out on Wednesday.
Thursday.
Is that right? Thursday. And if it comes out better than it's been, right? It's been in the 8s basically for the last few months. If it comes out nice and low, and it seems like we can attribute some of that success to the Fed's, tightening, how quick do you think the Fed is to respond? Are they going to respond as early as the December meeting saying, hey, maybe not 50 bips, or maybe they do 50 bips, but they say, hey, it looks like this is really working. We expect we might be able to slow down soon. Are they going to be quick to react to maybe possibly transitory reductions in inflation, or do you think they're gonna wait to see multiple months of lower inflation?
That's a great question. To be honest with you, Sean, I don't think they'll react super quickly to that. Maybe the market might, but um, at the end of the day here, one thing that they did note, and Jerome Powell did say this, is, and I would say this is kind of on the dovish side, or at least a relief to hear, is they acknowledged at least that they understand that data and monetary policy that they kind of are working on has lagging effects. Like,
Hmm.
just like
Sure.
we all know, you know, the Fed, hiked rates on Wednesday. That did not mean that, I don't know, your rent went down, essentially, or, the
Hmm.
rents that were offered in, your market if you're looking for an apartment, or, houses were just chopped by this much that day because of the rate hike. It takes time to show those effects, right? So at the end of the day, I think it's going to be encouraging to see this, but the Fed wants more, and they've always kind of held tight to their guns in terms of 2% is our goal, and there's still a ways to go to get to that, but they understand that they can't just hike forever and that be the case. I think what they want to do is hike harder and then cut back rather than under hike and then kind of play catch up still a year from now. So I think they won't really react too much to it. However, it may be a good sign for 2023 in terms of maybe a limited amount of hikes, if not, no hikes or just very small. And maybe just a 50 bip. We really, it'd be surprising to see another 75 bip hike, but we'll kind of get a little bit more color on in terms of how that's going to look, with the day that comes out this month.
All right, yeah, that's exciting. It's every month we wait on these inflation figures, and we're like, it's got to have had some effect, and then it's just another 8 on the board. So hoping that's it's lower this month, because I mean the fact of the matter is, like, the pain done to the economy by rate hikes, which is bad for jobs, and slows credit and stuff like that, increases the cost of housing, or the cost of borrowing anyway, is less than the pain of inflation, right? Like runaway inflation is way worse than a small uptick in unemployment. You think is that about right?
Yeah, exactly. And that's actually really the Fed's job at the end of the day. There's two things that they're really trying to regulate, and it's the inflation number and the unemployment number, and kind of making sure that they pull the right levers to make sure those are acting correctly. And I think at the end of the day, we can look back, and hindsight is always 2020. That's kind of the part of the job that's not very, envious of those that have to sit in that position. Like, I don't envy them because it's a lot of hard decisions they have to make. But at the same time, remember in 2020, we had a huge unemployment, and it was like, okay, we have to stimulate the economy to make sure we get those jobs back. And there was a huge amount
Sure.
of labor participation, right? Well, now we have, a really nice unemployment number, jobs that are continuing to grow. But at the end of the day, we have the inflation that was previously transitory, but now it's the forefront of their policies, right? So jobs are going to get hurt, but at the end of the day, this is part of their, prerogative of like, hey, we need to fix this inflation thing and regulate pricing. So for example, it might suck for some of us to deal with this high rate environment, but people who are retired who live off a fixed income, it's not good when you have inflation increased year over year at like an 8%, for example. That's a really painful place to be in. So at the end of the day, we need to fix inflation regardless of what kind of punch in the mouth we get in the short term. It's just the end of the day.
Sure, sure. All right, so we got as mentioned, we've got CPI coming out this week on Thursday, and I think it's time. I think we ought to do this every month. Let's get your guess. Let's get your guess. What's the number to the nearest tenth?
Uh, so expectations right now are for a 7.9% number.
Oh,
Um, I and last month it was 8.2, by the way. So I actually would say it's probably going to be around 7.9 or 8. I would be surprised if it went lower than 7.9. So I'm going to put it 8, just slightly worse than expectations. The reason why I say that is I think the commodity side of things has not improved. In fact, they keep on going up here in the short term, and I think that has everything to do with more of the international relations side of things. But At the end of the day, I don't think there's been much relief at the pump per se or energy costs. So I wouldn't expect there to be a really nice inflation print by any means.
Wow. All right. You heard it here first. Austin says 8%, worse than expectations. Go ahead and get your short positions in on U.S. denominated debt with your broker, and just profit from the profit.
There we go.
Here. All right. So other big news tomorrow. What's happening tomorrow?
I mean, not too much tomorrow, if I remember correctly, but
there's one big thing.
Oh, one big thing.
The election.
Oh, yes. How could I forget? Yeah, I guess I'm thinking about economic calendar, but
sure.
Yes, the election's tomorrow. I think that will actually have an interesting effect on the market as well. You can read into polls all you want, but at the end of the day, once the dust settles, what you get is what you get, and we'll kind of see how it all pans out. Obviously, this is kind of the control of the Senate. That is the biggest. Control the Senate and the House, I guess, is the biggest thing that's on the table here. So we'll see how this all pans out. And, I don't know what to really expect. I'm not an expert when it comes to politics and how you predict polling or anything like that. But I think this can kind of, have a lot of effect in the market in terms of like sentiment, in terms of where things are policy driven. And policy does a very big impact on the market, as we can all kind of gather from the previous years we just lived through. So I would say in general, it's something to very closely pay attention to, especially the results and how the market reacts to it. I would not base your locking on your predictions on how the midterm election is going to go, by the way.
Or your political affiliations.
Yeah. So I don't know if that wants to tailor into our next subject, but do not lock based off of what you think will happen, or do not decide not to lock if you think election is going to go one way or another. That's what I would say.
Yeah, I think in general, what I've learned is, there's wisdom to the term. If you like it, lock it. I say, even if you dislike it, lock it. I mean, the good thing about our platform, the UMortgage platform, is that with all the wholesale investors we have the best float down policy in the world. We can either renegotiate with the lender you're at, or we can just move it to a new lender. So, if you have a loan to lock today and, you see the 10 years at 4.15 and rates are high, and you think there's a possibility that, if one side sweeps tomorrow, both houses, something you think that's going to be good or bad for rates. If you think it's going to be good for rates, that's great. So just take them today. And then if, rates drop 75 basis points tomorrow, just move it. It's not something we want to do all the time to our investor partners. It's not something we want to do to the lock desk. It's not something we want to do to our processors. But at the end of the day, we need to keep our clients happy. We need to keep them in a place where they're not going to shop or go elsewhere, or think that we're, making too much margin or money off of them. So if you like it, lock it. If you dislike it, lock it. You got too many options to be playing games with clients or your own money. So, all right. So we've got this week, we've got the election, and then we've got CPI. What about the rest of November? Do we have a lot of economic data coming out? I mean, obviously we have stuff coming out every month. What do we need to be on the lookout for?
Yeah, I think it's really hard to look past the inflation number that happens on Thursday. And actually Friday is to make matters even more interesting, Friday is actually a day the market is closed on the fixed income side, which it's Veterans Day. So just a kind of an early, thank you to our veterans, and I appreciate all of your service. But that it does mean the market is closed on Friday. So, the market's going to have to digest the inflation numbers all day on Thursday. And then Monday, we'll kind of open up to a whole new can of worms, and we'll kind of discuss, what to look out for the rest of the month. But I think that's kind of the main thing here. Let's take a look at inflation, what happens there. And that'll kind of set the tone, I think, for the rest of the month. But, we always have jobless claims come out every week. That's always something to kind of pay attention to, and that happens usually in the later half of every week, and seeing how that's developing. It's still like stayed really strong over the past months. The labor market still looks really healthy.
Yeah, for sure. All right, well, it should be an interesting next couple days. I personally love I love chaos. So I'm really looking forward to it. And yeah, if you guys have any questions about upcoming stuff, about things that have happened in the past, about the way things work, drop it in the comments. We'll address it in the next week's edition of this. I'm sure we'll have a ton to talk about, and we'll be able to digest what happens and kind of is ongoing. I'm sure some of these races are going to be too close to call and stuff like that. So it should be pretty interesting to see the effects that has on the market. But in the meantime, go get some loans. Let's go lock them, and if we need to, we'll just lock them again. Thanks for being here, Austin. Thanks for watching, everybody, and we'll catch you guys next week.
Yes, thanks, Sean. Thank you guys for tuning in. Have a great week.